Good morning from our global headquarters in New York. I'm Manus Cranny with Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
The Israeli military edges further into Rafah as the U.S. pauses an arms shipment to Israel on concerns about a potential military offensive in the city. TikTok sues the U.S. over a law that would force its Chinese parent company ByteDance to sell the app or face a ban. And Chinese iPhone shipments rise 12% in March after Apple and its retailers slash prices. Manus, go Apple.
Danny, good morning. Yeah, Apple is moving. It's not really impacting the top line of these markets right now. Up 0.5% on Apple because their shipments, their iPhone shipments to China climbed by 12% in March. So keep an eye on Apple as we run through the morning. Look, we've retested the 5,200 level. Earnings are up nearly 9% on the S&P 500. Yields have come lower. Lyft is also moving. They're adding riders at pace. So two of those tech stocks doing quite well. Right now, we're just dipping on the futures back into the red. We're bleeding different directions through the morning. In terms of the bond market, what you can see here is 446. We've dropped by 21 basis points in 5 trading sessions. The 3-year auction went quite well. Today, we're really going to test the 10s. There is $42 billion worth of 10-year government bonds coming to the market. Paul Ryan warned yesterday that neither administrations are potentially facing their debt issues, and you could face some kind of a debt catastrophe. Dollar yen. Now, look, this is the dollar again testing on the upside. We've had more comments from Ueda coming through. The Bank of Japan governor warning that monetary policy response may be needed. I mean, this is flip-flop Ueda, depending on the FX market. So they're testing the resolve of the Bank of Japan. Yen cheapens for the third day. It's as if intervention didn't happen, but it's being challenged. And there's new headlines from Ueda. Danny.
That's right. Ueda is speaking in Tokyo, Manus, saying that it is hard to estimate rate hike impacts in Japan, also saying that the price trend is firmly moving towards 2%. And this is key. He says that we see signs of a virtuous cycle strengthening and that the shift in firms' price and wage setting is becoming clearer. These are lines that sound very different from the Ueda we got from the last BOJ press conference, where he sounded more dovish. This is a Ueda talking about inflation strengthening, talking about the virtuous cycle. It was only a month ago, less than a month ago, where he even said that the yen isn't having a major impact on underlying price trends. And that's sounding different. And
that's why what I'm saying is, you remember Mark Carney and people lambasted him as being, the flip-flop central banker. But here he is, Ueda's talking about high oil prices may weaken the premise for lower cost push pressures. And just on that sort of shift again in dollar yen, testing the dollar up for the third day in a row, if we looked at the retail volume is what's pushing the dollar higher. Individual investors reached 27% of the total transactions on May the 3rd. That is the largest this year.
But again, that's perhaps why we're not seeing more of a reaction for the yen. It is still weaker this morning, but you have to imagine, Manus, that the BOJ is also feeling the government pressure of the issue of a yen, of what it costs to go abroad and what it costs to import anything. Exactly.
More tourists and probably there's a bit of a pushback maybe on that. But monetary policy response may be needed. We'll talk more about the yen as we go through the morning. Back to stocks, because globally they have staged this comeback so far in May, fueled by the prospects of, you got it, Fed rate cuts. Minneapolis Fed President Neil Kashkari spoke to Bloomberg at the Milken Conference and discussed the 2% inflation target.
The second half of 2023 surprised us at how rapidly inflation fell. That was really good news, and the economy remained strong. We all hoped that was going to continue. The first quarter of this year, it seems like it stalled out. So it's a little too soon to declare that we're definitely stalled out, or maybe it's just taking more time.
Our guest this morning is Max Kettner, Chief Multi-Asset Strategist over at HSBC. So we've hit stall. I think we can all land on that as a consensus. Max, a very good morning to you. But not only did he quote the stall speed, but he also reopened Pandora's box of the possibility if they needed to hike that they would. So he's diametrically opposite to Powell. And he talks about questioning whether we are in restrictive territory. So I think he flew a lot of kites yesterday to perhaps reignite optionality for the Fed. Good morning, Max.
Good morning, Manus. Yeah, and thanks for having me. I don't agree with that. I think we've sort of heard from him what we're used to hear from him. But in terms of the rate hike possibility, I think it is and has become clear last week that the bar for additional rate hikes is extraordinarily high, right? Really, really high. It really does, it does not suffice to have inflation continuing to be stuck. And that is essentially what's been happening since June last year. If we look at headline inflation and we don't bother with, super core or excluding all sorts of things that we don't like and then including them 2 months back after again. If we look at headline inflation, quite frankly, it's been stuck between 3 and 3.5% since June last year. So in reality, I think as much as we got excited and as much as we exaggerated at the beginning of the year in terms of our dovish expectations, I think the market is now exaggerating on the hawkish side and is sort of treating this as if the world has changed upside down and is entirely different now, even though nothing really has changed on the inflation side.
Max, are you saying that people cherry pick inflation data to fit their own narrative? I have never heard such an accusation. Max, okay, so if we've gone too far in the hawkish narrative, does that mean that the come down we've seen in the front end and really in duration too, that it's not yet over, that we need to price back in some of what we took out to start the year?
Yeah, I think, duration overall has become a lot more attractive, particularly in the US, and particularly if you think from a portfolio, from a multi-asset and asset allocation angle, you're clearly seeing that, now from a hedging perspective, treasuries and duration has become much, much more attractive because, let's face it, at the beginning of the year, for example, short-term inflation expectations were already below target. They're now almost 100 basis points higher. We have seen in April this spike in interest rate volatility. So that is behind us as well. When we looked at longer dated nominal forwards, at the beginning of the year, they were at or below 3% already. So extremely low, right? We had these 7 or even more rate cuts in the price at the beginning of the year for the ECB and the Fed. All of those things, whether it's the nominal forwards, whether it's interest rate volatility, whether it's short-term inflation expectations, all of those things have really changed. So the starting point for owning duration now has become much, much more favorable compared to 4.5 months ago.
So the question then is, we're going through various recalibrations, to choose a phrase, from the Fed and to choose one from you. We've gone from 7 to virtually 0 back to 2. Do you think that is the right recalibration? Is that the 1990s? Is that 2019? As you reflect, is your view those are the kind of rate cuts that we're going to get, and that underpins pro-risk cross-asset?
Yeah, I think that is the case. I think you're really right on that one, because I think by the end of next year, it's much more likely that we're going to get maybe 3-4 rate cuts. So we've got 100 basis points of total rate cuts by the end of 2025 from the Fed. And that, that's not a genuine start of a real rate cutting cycle. It's not one where we should be bothering so much about the starting point. I don't think it really matters whether you own high yield or equities or emerging market debt or any kind of risk assets there, really. I don't think it really matters whether, the Fed is going to go in June or whether they go in September or December, as long as the H word, as long as the hike word is not coming back into play, as long as it is, okay, the next one is going to be a cut. We just don't have the confidence quite yet. But don't worry, in a couple of months, it will come down and we'll start cutting. The much more important point is that it's going to be more like a recalibration, like you said. And that, I think we are going to be bouncing around between those extremes in the next couple of months. We'll be pricing in maybe 4 or 5 rate cuts at some point again, because it looks more like Goldilocks. Then we look a bit more like stagflation again. So you've got to trade those ranges, I think, in rates. But for equities, for high yield, for emerging market debt, for those risk assets, it's really pretty positive because it's a reflection of better nominal growth.
And Max, this is when, last time you joined us and in your notes, a certain fairy tale character tends to come up quite frequently on that. Of course, she's Goldilocks and the growth is there. You can see it in the earnings. But Max, what do you make of the smaller pieces of anecdotal evidence, whether it be your Starbuckses, your McDonald's, or even some of the consumer sentiment survey? Does that not concern you that maybe all isn't okay with growth?
It doesn't concern me. If I'm going to the Bloomberg studio, for example, I get coffee for free, so it helps my personal CPI basket. That's good, right? But I guess if we're talking on the anecdotal evidence, yeah, there is some certain pockets certainly that look a bit wobbly. There is certainly things like credit card delinquencies picking up, perhaps private household bankruptcies picking up. Those sorts of things, those pockets clearly are, looking a bit wobbly. But we also need to bear in mind two things. Number one, whoever's been ever charged with putting together, a list of macro variables, call it 20, 25 variables to gauge where we are in the cycle, you will always find that there's going to be some variables that will look out of whack with the others. There's never really going to be a cycle where everything gives you the green light. That's point one. Point two is, in fact, when we look at these weaker points, what we are seeing is that most of them are still very far away from the pain points where we've been before the financial crisis. So we're not even reaching average levels in terms of, for example, credit card delinquencies, where we were on average before the financial crisis. We're still miles away from that. And that, gives us still a bit of a buffer until things really start to be a bit more dramatic, I think.
Okay, Max, thanks so much. Thanks for bringing your own personal CPI basket with you, Max Kettner of HSBC.
I feel sorry for him now. I think we should pay for his cab.
I think we do, no?
We probably do. I didn't want to say that to him.
Max, thanks so much. Have a good rest of your day. Okay, let's get to some of the other top stories trending on the terminal this morning. Riksbank has cut its benchmark rate for the first time since 2016. The Swedish central bank lowered its rate by a quarter point to 3.75%, and the move makes it the second among advanced world peers after the Swiss National Bank eased post-pandemic.
JP Morgan is limiting its dealings with Seganti Capital, the Asian hedge fund giant charged with insider trading by authorities in Hong Kong. According to Bloomberg sources, JP Morgan won't engage with Seganti on new block trades and IPOs. That's on a global basis. It's long been a prized client of Wall Street banks that need to unload chunks of shares in block trades and stock offerings. Seganti says it intends to defend itself against the charges.
Donald Trump's criminal trial for allegedly mishandling classified documents has been postponed indefinitely. It's a significant victory for the presumptive Republican presidential nominee, who is facing 4 criminal cases and is seeking to avoid multiple trials before the November election.
Coming up, TikTok sues the U.S. government. The details on the legal fight. That's next.
But first, we need to discuss the U.S. pauses a weapons shipment to Israel over concerns of an invasion of Rafah. All to come on Bloomberg. This is Bloomberg Brief. Danny Berger and Manish Crandy in New York. So the U.S. has paused a shipment of weapons to Israel over concerns about Israel nearing a decision to launch a wide-ranging military offensive in Rafah, which the Biden administration is opposing. Let's bring in Bloomberg's Roz Matheson. So, Roz, these specific weapons, they are larger bombs, the idea being if they are going to be on the ground in Rafah, it would be catastrophic to use these type of weapons. So by not giving them to Israel, does it really impact things on the ground? Is this something they actually would have used?
Well, it's unclear how much it would have impacted, but it's really symbolic more than anything else. It's about the US sending a direct message to Israel again about their concern about the impact potentially of a large-scale operation inside Rafah, particularly with so many civilians in the area, and just the optics, the US not wanting heavy bombs that the US has provided being used in that area when we have so many civilians. So it is a symbolic message from the US. Would it impact the trajectory or the nature of a large-scale Israeli operation in Rafah? That's unlikely, although it may have assisted them somewhat. But more broadly, the US is not stopping the support of Israel militarily. They're not stopping the supply of military aid to Israel as a whole, and certainly nothing that they say would help Israel defend itself, especially, things like the Iron Dome missile shield and so on. And so that big military package we saw recently passed in Congress, that's not stopping. It's just halting the specific thing, which are these heavy 2,000-pound bombs, several thousand of them that the US was going to supply. But certainly the US could not afford the optics of having those weapons being used in Rafah.
So it's a moment of symbolism that the White House has chosen to display. I mean, the White House has repeatedly expressed opposition to the Rafah incursion. John Kirby on Tuesday described the existing operation as limited. Is it limited? How would you describe the offensive right now in Rafah?
Well, it's certainly picking up a bit. I mean, we've seen yesterday, of course, that they occupied the Rafah border crossing. That's the first time they've been in there since the war broke out. There have been airstrikes that have been going on. We know that there are fighting going on today in the east of Rafah between groups on the ground and Israeli troops. So certainly the fighting is still going on. More Israeli troops are going in there, but it's a bit of a slow walk. It's one of those things where we may not see that one moment which we say there's now a big offensive going on inside Rafah. It could be a bit by bit, things pick up, and over time it evolves into what we would class as a full-scale operation. But it does seem that, you know, each day Israel is stepping it up a notch, and that's as time is running out, obviously, to get that ceasefire more broadly. Those talks are still in trouble.
Roz, thank you very much. That is Bloomberg's Roz Matheson. Now, back here in the U.S., of course, the unrest on college campuses continue. As recently as this week, Harvard threatened protesters leave the encampment or face suspension. The university's professor of economics said that college campus protests against Israel are partially fueled by economic disparity. Raj Chetty spoke to Bloomberg at the Milken conference about the challenges in the education system at this time.
Finances are part of it. I think part of it is somehow making teaching more of a prestigious profession where people feel like this is something that I really aspire to do. But I also think part of it is just about flexibility in the way we pay people. So in most public schools in America, there's a lot of rigidity where your pay is basically set as a function of how many years you've taught. If you've got a star teacher who's really inspiring your students, there's no way to reward that teacher and say, you know, we're going to pay you extra, give you that bonus, really work hard to try to keep you. In most of the jobs we're all in outside education, if you've got a star employee, you're going to try to keep that employee. And I think giving schools that latitude can make a difference.
Raj, I do want to go back to colleges and universities and the process for prospective students to get into those universities. There's been a lot of back and forth over admission requirements, whether you use standardized tests, whether you don't. I know Harvard has gone back and forth on this here. What is the best barometer to measure whether a student is acceptable enough to be part of your university?
So our team has been studying these issues recently. Last year put out a paper trying to understand who gets into highly selective colleges. Does it matter how you should evaluate students? Part of what came out of that paper is very clear evidence that standardized tests are actually some of the best predictors we have of how well kids do in college and after college. They're not perfect, and we worry that, you know, you can prepare for tests and you can take the test multiple times, and there may be certain biases inherent in those tests. But the issue is that the other things that you might use if you don't have standardized tests are even more prone to those biases. So if you put weight on things like high school grades or extracurriculars or your rec letters, kids with more resources have more of an opportunity to credential themselves on those fronts. And the data show that that is actually a bigger set of biases. Those outcomes become less predictive of how well kids will do than standardized tests. And so in light of that evidence, actually directly as a result of that research, we've spoken with folks at a number of colleges, and they have started to bring back standardized testing.
One last question. I'm not going to get into politics, but the protests that we have seen on campuses across the United States, including Harvard, I am curious, how do we get academia, higher education to be a safe place once again for discussions with variety of thought?
Yeah, I think the challenge here is to realize we're all in it together and to kind of create a framework in which we can share ideas without necessarily disrupting other people's learning and to respect everyone's views. I think some of those protests are emerging from fundamental tensions about what people think about opportunities. Do we really have a fair society where everyone has a fair shot?
Raj Chetty in conversation with the Bloomberg team at the Milken conference from Harvard University. More on the main stories this morning on Bloomberg Brief. Breaking news now coming through from the Bank of Japan. Danny, this is Mr. Ueda. Abrupt, one-sided, weak yen is negative for the economy. Again, this is an evolution of the jawboning by the Bank of Japan. A little bit earlier today, the governor made it clear, and this is, I think, what was ignored by the market and shocked you and I. Bank of Japan governor warns monetary policy response may be needed depending on the FX, and this is diametrically opposed to where we were just 10 days ago.
Yeah, so in the BOJ press conference, he had said that they don't target any sort of foreign exchange rate, and he was asked directly about the yen. And he said it's not having an impact on inflation, therefore they're not taking action. Manus, this brings into the fore the concerns about the trustworthiness of UATA. You could imagine perhaps there's some pressure from the government in order to act because of issues like import prices and what it costs to go abroad for the Japanese public. So here you have a UATA that's taking a shift in tone, which, by the way, isn't impacting the exchange rate itself. But perhaps is impacting his trustworthiness.
Well, it's about whether you believe in a central banker. It's about whether you believe in they're going to put their money where their mouth is. Look, there's a couple of other stories which I think we just need to sort of get through that are on the front pages. This is what we usually do at this stage. We'll come back to UATA in just a moment. We've got the FDIC. They've got their own internal report, Danny. They're talking about the outcome of that. We'll bring you a little bit more on that
They
later.
had a probe about misogyny in the workplace, and essentially the outcome was, yes, we found it.
And FTX, now this is a blinder, isn't it? I mean, if you're a creditor there, you're going to get paid out and paid out plenty because there's more money as a result of all the cryptocurrencies rallying.
Yes, the irony is they're worth more than $16 billion, about what they were worth in 2020. So there you go. From our global headquarters in New York, I'm Danny Berger alongside Manus Cranny. Let's set your agenda.
The Israeli military edges further into Rafah as the U.S. pauses an arms shipment to Israel on concerns about a potential military offensive in the city. TikTok sues the U.S. over a law that would force its Chinese parent company, ByteDance, to sell the app or face a ban. And Chinese iPhone shipments rise 12% in March for Apple, and its retailers slashed prices. Danny, good morning.
Good morning, Manus. Sadly, Apple isn't coming to save the day for this equity market. We're taking a breather after 5 straight days of gains for the S&P. Tech underperformed yesterday, a little bit lackluster. On the futures market, yes, we're above 5,200. We hit that on the cash market yesterday, pulled back from it. Also, a 5-day streak of lower yields for your U.S. 10-year yield. 447 is where we stand this morning. We're up by 2 basis points. We have fallen 24 basis points since the peak in the FOMC. Max Kettner saying the hawkishness has gone a little bit too far, but if we're cutting, it doesn't really matter when we start. As long as it's 3 to 4 cuts, that's not a normal easing cycle, and therefore it should not impact risk assets. Now, when it comes to the yen, Manus, this is quite unfortunate. Yen weaker versus the dollar by nearly 0.5%. If anything, it's gone a little bit weaker this morning after we heard these headlines from UATA saying that abrupt, one-sided, weak yen is negative for the economy and saying that Japan's price trend is moving towards 2%. That's the kind of language that says perhaps we're going to hike. Hey, market, you shouldn't be selling yen, but this is what we're getting.
Yeah, but do you know who is selling yen? It's retail investors. They are piling in. They're shorting yen like billions. So this is definitely testing the mettle of intervention. We saw $60-odd billion last week, very compressed period of time. We've reflected on this. Retail sellers, let me just give you the stat. The volume of dollar buying, yen selling by individual investors reached over 27% of total transactions on May the 3rd. That is the largest this year. So this is not just institutional long dollar short yen retesting. This is now a zeitgeist. This is now hopped on the train. Everybody's on it. The retail sellers are in there as well.
But this is the thing, the confidence of someone to look at what UATA says and, okay, I'm going to trade on that. It is thin because, one, what he said at the last BOJ presser was different. He said that they don't target FX levels and it's not having an impact. And secondly, we know that the BOJ likes to surprise the market. So perhaps it's a market that says, we're not going to believe you until we see that decision, until we see price hikes.
Yeah, but he did say this morning as well, monetary policy may be needed depending on the FX move. And that's the first hint that perhaps we're moving from that dovish stance that he had just 10 days ago at the meeting to something a little bit more punchy. So, you know, it's not reflected in dollar yen this morning. That's for a fact.
I know. For all the jawboning, not much to show
of it. There.
Okay, Manus, let's switch to equities that have seen, again, a 5-day winning streak. Our next guest writes that equity markets, though, will remain challenged with continued influence of still high rates, stubborn pockets of inflation, and mixed economic data. Overall earnings growth is improving, but individual sectors are vulnerable. Joining us now is the woman behind that. It is Lori Heinel, Global CIO at State Street Global Advisors. Lori, great to see you this morning. Okay, so tell me, what's still vulnerable at this point?
Well, first of all, we do believe that the economy continues to slow, and we do believe that inflation continues to come down. And so basically, any place where the markets have relied on consumers to propel them higher, we think that those are going to be pockets of vulnerability. So think about consumer discretionary as one example.
Laurie, good morning to you. Consumer discretionary. Yeah, I mean, we're just having that conversation with Max Kettner. Now, he's a lot more bullish on this market. He would say that the weakness in the consumer, in other words, the delinquencies on the credit cards, the slowdown is nowhere near as bad as it was pre-GFC. Your assessment of where we are, those pandemic savings are rolling down, they're into negative territory. Are we going to have just a bumpier, to use the Fed's language, a bumpier back 6 months for the consumer?
Absolutely. And again, this is not a GFC kind of moment. So we're not seeing collapse in credit. We're not seeing collapse in consumer. We're not seeing collapse in property prices. So there are lots of things to like about where we are at this point in time. But the underlying narrative continues to be quite fragile. So you do have a consumer that's more exhausted. We're seeing that in savings rates. We're seeing that in the lack of high wage growth, things of that nature. You also have an environment where there still is a lot of flush in the system. We still have government spending, for example, on things like the CHIPS Act and the IRA. So this will be supportive. So there are pockets of goodness, but there are also pockets of vulnerability. And that's what we think should actually be driving the Fed as they look at their next meetings.
Laurie, then why among those pockets are we seeing an earnings growth that's looking something over 5.5%? Why is that so strong then?
Well, again, it's one of those dimensions of it. Some of it's the year-over-year comparable. So you do have companies that are able to absorb the inflation that we had in the past and continue to actually raise prices. And so that's actually propelling them higher. But you also have, companies have been quite lean. They've been very careful about how they've spent their dollars. They haven't invested in capital necessarily. They've returned money to shareholders. So there are some underlying dynamics there that they continue to maneuver around, but that also only has certain limits.
Does this build the narrative even more for bonds? If you look at the bond market, it has recalibrated. It's a lovely word, and I think it does encapsulate 22, 23 basis points of drawdown in yield, in 10s, and likewise, 2s are below 5%. So we've had this sort of moment of recalibration. Do you think that that extends, and is that why you want to be longer of treasuries relative to credit?
Well, as you probably remember, we were calling for bonds to do extremely well in 2024. And so far, that's proven challenging. Yes, you've gotten a little bit of carry, but price action has not been in our favor. We actually think at these levels, bonds are quite compelling. Now, how quickly you dive into bonds, especially with the Fed being a little bit more measured in its rate hikes, we're still holding fairly high levels of cash relative to what we would normally see in the portfolios. But we do think that the entry point on bonds is very attractive right now.
Laurie, this is the thing. I mean, you're not alone in saying that this would be the year of the bond bull market. So many people have said that to us. So when it comes to things like, okay, yes, bonds are finally going to perform, equities are going to be a little bit weaker, those calls have been extremely challenged given, to use Manas's phrase, quoting the Fed, the bumpiness of this economy. I mean, it's been impossible to time, right? So you have these ideas, but how much conviction can you actually hold them in what's in your portfolio?
Well, a lot of it depends on your time horizon, right? If your time horizon is next month or next week, we still think the momentum trade favors equities. And we were also, as I mentioned, are holding fairly high levels of cash because we want to be more opportunistic when we get those corrections in equities or when we start to see the Fed be signaling perhaps a bit faster path. So one thing is hold a bit more cash, disperse your bets a little bit, look for those diversifiers. We have had a tactical position in gold in the portfolio for most of the year, and that has served us very, very well. But also think quality, because one of the things that you want to try to avoid are those deep drawdowns. So even in things like high yield and equities, look for quality where there is durability of earnings and pricing power.
You sound like a very reluctant holder of that cash, which sort of gives me a little bit of faith in that it's probably not the wrong thing to do. Now, you said if there's a drawdown in equities, if there's a bit of a rumble in equities, you'd be tempted to go back in. Is that going to be the trigger point for you, Laurie? Is it going to be deploy to equities over credit, over bonds, when that moment comes? Or how do you look at the landscape for reallocation?
Well, there are really two major things. Certainly, if we get a pullback in equities against a sort of stable backdrop in the economy, that would give us some confidence that, valuations are attractive and it's time to actually increase our allocation there. But the other really important thing is, what's the economic trajectory? Again, our view is that the economy is going to slow. We have recession odds in 2025 at about 30%. So that's still kind of heightened. So if you do see this fragility or the vulnerability that I talked about earlier broadening, and we start to have an environment where, high hawkish rates really drive the economy into a bad place, then that's a different ballgame. We're not there, but that's really what ultimately drives the market, is the fundamentals.
All right, Lori, really appreciate your time this morning. Lori Heinel of State Street Global Advisors. Okay, coming up on the show, TikTok's owner puts up a legal fight with the U.S., while the former Treasury Secretary, Steve Mnuchin, says he's still interested in buying the app's U.S. operation. We're going to have more of that next on Bloomberg Brief.
Still very interested in buying it, and to the extent they want to sell it or spin it off, we very much want to pursue that. I support that Congress passed the bill and it's now been signed into law. I will say this has had just incredible, overwhelming support with Republicans and Democrats. This may be the only thing that everybody agrees on. The fact that it's on 160 million phones, I do think it's a security issue.
The former Treasury Secretary, Steve Mnuchin, there, still looking for a piece of TikTok, while its Chinese owner, ByteDance, sets the stage for what could be a long legal fight against the United States. Let's bring in Tom McKenzie for a little bit more. So TikTok is going nuclear. They're going to sue the president. They're really pushing back. They are not rolling over at the moment on ByteDance and TikTok, are they?
They are not, and this legal action suggests that they're not looking for a partner with which to divest as well, because those were the two options after, of course, that ban or that piece of legislation was signed into law back, of course, in early April. The choices were you either divest or you get banned by January the 19th. They're pursuing this legal action. They say there is a freedom of speech, a First Amendment rights issue at play here. Of course, the US government says this is a national security risk. Interestingly, on the time frame, Bloomberg Intelligence, the team there, expect that this actually could be expedited by the courts. You could see a ruling by the end of this year, and then it goes to the Supreme Court. That is the expectation from Bloomberg Intelligence, and possibly then by the second half, potentially second quarter, I should say, of 2025, you could get that final decision. And Bloomberg Intelligence puts their chances, ByteDance chances, at about 30% of winning that case.
Awful timing for Manus Cranny, who literally just became a TikTok star. In a sign of the times, he's already starting to move everything over to Reels, so he knows he's hedging his bets.
She's my manager, actually, Tom. You should get her on board. She charges a very small commission, does a great job.
She's good.
Yeah, I've already convinced Manus to take out his millennial pauses, so we've come out a long way. Tom, elsewhere in the tech and specifically the tech China world, I mean, keeping your head appraised of the Apple data is difficult in China, but the official data we've gotten this morning is that March iPhone shipments rose 12% after they had a lot of discounts. Are we in the all clear yet for Apple in China?
Yeah, look, you're absolutely right. We've been whipsawed by the data in terms of the sales numbers out of China for Apple, which, of course, about 20% of its sales in terms of the iPhone come from that key market. And we saw at the beginning part of this year, of course, and this is what you're referencing, double-digit drops in terms of sales of that crucial iPhone into that Chinese market. Now the most recent data coming through from the official Chinese data suggesting that in March they saw a 12% increase. That coming through after a lot of cutting of the costs, I should say. Rare. I'm getting there. I've been distracted by Manus on TikTok. But the price cuts have come through for Apple, and that seems to be supportive. They're seeing a pickup in sales. Don't forget as well, the consumer generally in China is turning a little bit more positive. You've seen that in some of the holiday season data as well. Not back to pre-pandemic levels, but the consumer is starting to sense and starting to become a little bit positive. So you get that in combination with the cost cutting that came through around the iPhones, and maybe this is turning the corner. Interestingly, Tim Cook on the call around the earnings said that they have seen growth, that they are seeing growth in the current quarter out of China, though he wouldn't give more specifics.
Let's just wrap it up on the US's most recent move. Now, this is on Intel and Qualcomm. I just want to get a sense. They've revoked some of the licenses on selling chips to Huawei, but is it more political theatre rather than a significant blow?
I mean, certainly the Biden administration is under pressure to take a harder line, even though it has taken the Trump tariffs and restrictions and ramped those up. It does come under pressure and has been from Democrats and Republicans. So this may be part of that play. Maybe it's political. I think there's also a real concern that Huawei, which has become now at the vanguard of China's efforts around AI, can start to produce very sophisticated chips and components, and that the input from the US, from the Netherlands and Japan is going to be consequential to that. So they had licenses, Qualcomm and Intel, to sell some of these components to Huawei. Those licenses have now been removed, so that restriction has been tightened. But this is already a very heavily sanctioned company, Huawei. It is not amongst the top 10 customers for either Qualcomm or Intel. So on one level, this is a small deal in terms of those two companies, but at the broader picture, it just shows that effort on the national security front in the US to tighten these restrictions, particularly aimed at what is becoming a champion for China around AI and Huawei.
Tom, appreciate it. Bloomberg's Tom McKenzie there. All right, from TikTok to Reddit, I want to get a quick check on the share price pre-market because it's extending gains 14% this morning after posting their earnings, the first since their IPO. Let's go over to Charlie Wells on this. So, Charlie, we had this monster IPO from Reddit. I guess they're living up to those expectations.
They're living up to those expectations and surpassing them. I mean, Reddit needed this. This was their first earnings report since that very high-profile IPO. And what we saw was a beat on revenue. It was up 50% from the year before. That came off of improvements in their ad platform. So 98% of revenue from Reddit has historically come from advertising. So that was incredibly positive. But looking to the future, and I think that's what we're really seeing in this share price action, is that AI magic dust that really gave the IPO quite a sparkle, I would say, earlier this year. And what we're seeing here is the numbers supporting daily active user growth. So that in the quarter was up 37%. There are more communities on Reddit. There are more people joining. And that makes that proposition of data licensing, of licensing to the likes of Meta, of Google, to OpenAI, a lot more attractive because there's more data, there's more content to train these large language models. And that has been the pitch for Reddit as they try to diversify between being that ad business and being more of an AI or at least AI adjacent business.
Charlie, thank you very much. It certainly was a blistering moment out of the gates there yesterday for Reddit, and that continues this morning. Danny, if you look at what the CEO is talking about, I think the next biggest business model for us is what we call the user economy. So it is about adapting that AI model over the data and enhancing that. So let's just keep an eye on that. It's certainly bid up this morning. We've got other earnings news as well. We've got Rivian falling short of Wall Street's earnings expectations to start the year. The automaker working to revamp its manufacturing operations to boost the output of electric vehicles. Bloomberg's Craig Trudell joins us now. So what are we seeing? I mean, the stock had a sell-off on the back of the report. What is the outlook for Rivian? I mean, it's been a challenging time all the way around, and this is about trust in deliveries, really, isn't it?
Yeah, I think that's right. This has very much been a show-me stock where, you know, on paper, as it was going public, it was, you know, ticking all the right boxes. At that time, you know, if you were EV, you were very hot. You know, Tesla was still very much, you know, a meme stock and the talk of the auto industry. I suppose that last part is still the case, that we still talk about that company quite a bit. But I think we've seen this EV slowdown that, you know, it's gone from a situation where, you know, being a pure play battery electric vehicle maker has gone from being a strength to a liability. And I think Rivian has really struggled to execute, has struggled to hit its numbers, and is in a bit of a holding pattern right now of trying to, you know, improve the utilization of the factory capacity it does have before it, you know, makes big investments in new facilities. And so we're going to see, you know, this current quarter, you know, a pause in production, and that's going to, you know, be something that they are really going to have to sort of prove to the market that pause was worthwhile and potentially break even toward the end of this year.
It's all about proving that your original business model can work, something that Tesla is learning. And when in the Lyft earnings yesterday, Craig, which, by the way, were pretty good, more users doing bookings, but the company on the call was asked about Tesla trying to launch a robo-taxi service. And the CEO was extremely skeptical. I'm sure that's not something Musk is going to be happy about.
Yeah, it will be interesting to see if we get some ex post. I mean, some days he's weighing in on what J.K. Rowling is doing on his platform. So maybe we'll see. But I think it is interesting that this as a concept has been something that back in like 2016, 2017 timeframe. Uber and Lyft were talking about an awful lot. We're investing in. Lyft had a partnership with General Motors. I think the whole industry has kind of come to this realization of just how difficult and costly it's going to be to commercialize this concept. And Musk has very much sort of gone the other way of, whereas everybody else has gotten, religion as to just how much of a stretch this is going to be. He is very much doubling down on it. And so to hear Lyft's CEO sort of push back on this idea that this isn't going to be, simple, this isn't going to be cheap, really speaks to this idea that, people who know this business of running a shared fleet or running a service upon which a shared fleet of cars runs has an idea of just how much execution risk there is for Musk ahead.
Craig, thank you very much. That's Craig Trudell there on the latest tech stories. Coming up, we're going to set your agenda for the trading day right the way through on Bloomberg.
It's your Bloomberg Brief. Danny Berger and Manish Granny in New York. Okay, let's get you set up for your trading day. Archegos Capital, remember them? Their Bill Huang is going to go on trial in federal court in New York on fraud and racketeering conspiracy charges. We're also going to hear from Fed officials throughout the day. We're going to hear from Jefferson, Collins, and Cook after the bell. We got more earnings from Uber, Arm, and Robinhood. Manish, how are your stocks?
I'm going to kick off with Reddit. We just spent a bit of time there. They had their IPO. Stock is up 13.66%. So doing quite nicely. It's all about how you monetize the platform. Lyft, we also spent a bit of time on that, up 5 1/8%. They've raised their bookings for the outlook, so they're certainly adding users there. And then you've got their rival Uber reporting today, and it's expected to show continued double-digit growth in their gross bookings. I can tell you from personal experience, prices are definitely up on Uber. Yeah? Not gouging.
What do you mean? You're a man of the people. You take the subway. What do you mean Uber?
I just want to make sure we've got good market data on every form of transport available in the United States of America. I've been on planes, I've been on trains, I've been in Uber, and I've been in Lyft.
Love it. Manish Cranny doing channel check. Sell-side analyst, beware. Hey, Manish, a quick check on the 10-year because we saw 5 days of yields lower. That has started to reverse. Yields pushing ever so slightly higher today, but still, the fact stands, we have rallied 45 basis points lower since the peak on FOMC day.
And in the past 5 days, we have recalibrated, to use that favorite word, by 21 basis points. Today, it's 10-year government bonds. $58 billion of threes went well yesterday. Today, it's $42 billion of tens. Paul Ryan warns of a debt crisis in the next administration. Small issue.
Yeah, but the market's not trading on that. Max Kettner says duration, it's attractive, buy it despite the bounciness. Okay, that's it for us. Surveillance up ahead.